again, and we're going to talk today about how to set up your accounting software. Now, most of your accounting packages are going to have the software designed for your specific industry. If you go to QuickBooks Pro and you're setting it up and you're in the construction industry, it has a construction setup or a service company or whatever. I'm not necessarily talking about your basic accounting, and you need to get with your CPA on most of this too, but CPAs look at accounting for two things. One, to do the standard financial statements, the balance sheet, the cash flow statement, the income statement, and the equity statement, and also footnotes. The second thing they look for is setting it up so they can make it easy when they do taxes. What they typically do not do is set up accounting for managing the company, which is something I'm going to help show you how to do. So if you're looking to set up or learn to set up the software for QuickBooks or Peachtree, they have videos online. We have them on our site, and they have them online on their sites too, so you can go to those. I'm not trying to tell you how to necessarily step by step set it up, because it's really easy if you walk through their tutorials, but what to set up so you can manage your company. A chart of accounts is where you start. It's an arbitrary created list of accounts used by business entities to define each class of items for the money or the equivalent spent and received. It is used to organize financials, segregate expenditures, revenues, assets, liabilities. It's the items actually on the statements, the best way to put it, and you want to keep up with it. Now, I took that from Wikipedia, but basically there's going to be several types, and again we're going to go through those. Before you start, you got to think about, what are you trying to measure? For instance, do you know exactly what it costs, your hard cost? I mean, that's the cost of goods sold for each of your product or service line. I mean, how much is the average labor going into each product you're selling? How much is the average materials? You need to measure that, because if it's costing you $100 for time and labor to put into a widget, and you're only selling the widget for $90 and that's all you can sell it for, you're losing money. Even if you're selling it for $120, you may be losing money because it's not covering the overhead. So you really have to know these, and accounting systems can help you. Also, systems such as SAP can help you too, but those are very expensive and much more complicated. You can use especially for starting business, you can definitely use your accounting system to help you in those areas. And QuickBooks and Peachtree do have items. As a matter of fact, they can count your inventory for you. They can go really intricate, so you can do just about everything you want with these software packages also. COGS is a cost of goods sold. There's three items that you need to have on your financial statement. Your income, and you need to divide it by product or service type. Your cost of goods sold, that's the material. Now, some accountants vary on this, but I believe as a management tool, you need to have everything associated with the variable cost of the product. Now, variable costs are the cost the product actually costs to put together, not the overhead. In other words, if you have a booklet you put out and it costs you $30 that you can get in sales, that's what you receive in sales, and it costs you $6 to print it, let's just say. But that's the actual paper cost in the printing. It also costs you, you have one gentleman that does it, and he costs $30,000 a year plus his taxes, let's say another 25 to 30%. So let's take $40,000, and you make 4,000 of them in a year. You're actually paying $10 a book just for his time, not counting the capitalization on the machines to be used and so forth. So you need to know what it's costing for each product line. The gross profit, and the next thing you need to have is the income, then the cost of goods sold you need to know, and that's again, I'm going to go over it one more time. The materials, the direct labor cost, the people actually doing the manufacturing of the product or service. I even put in the commission cost if you've got commission salespeople that derive a specific percentage of sales for those products or services. And then you also want to put in there eventually for your management tools the actual overhead for them. In other words, the FICA, your withholding, and so forth that you have to pay so that you can have the total cost of the goods sold. When you take your income and subtract your cost of goods sold, that gives you the gross profit. And you want to know that for each product or service. Now, your financial statements won't break it out that way, but if you break it out in the financial statements, you can set up reports that can show it for each product. Your operating costs are the cost of general overhead. Let's say you have a bookkeeper, a receptionist, secretary that helps you, and yourself in the office. The wages and the benefits and the taxes for those individuals will be an operating cost, because it doesn't matter how many products you produce, you still have that overhead. You also have the overhead of rent, utilities, capitalized, cost of debt for your equipment and such. So those are all operating costs. Now, these are the three areas, and we'll talk about them in a little more detail later. But these measurements should be listed both in dollar figure percentage. You want to not only know how much you make on each product, what your gross margins are. Just, you want to, all right, my gross margins are 58%, 64%, whatever. That's what you need to know. Assets and net assets is another measure. You want to know how many assets you have. That's on the balance sheet, and your net assets after your liabilities. And there's many more items that you want to measure as management. I'm just naming a few here. The financial statements really involve 5 documents. A balance sheet, which is basically the assets minus liabilities giving your net. The income statement, which is your income subtracted from your gross cost of goods sold, giving you gross profit. And then you subtract your operating expenses, which gives you your net profit. That tells you how much income you're making. Cash flow. Just because you have income, I've seen a lot of companies make tons of income and go broke because their cash flow's bad. You're sitting there saying, Howard, how does that happen? Simple. If you've got a product that takes 2 or 3 months to deliver, and you get too many orders at one time, and you cannot finance the cost of goods sold, the materials and the equipment and the people necessary to put these things together, you can run out of cash sometimes before you actually make them take delivery and are paid on that product. There's ways of managing that too by factoring and other things. So, I don't want to go through everything here. I'm just mainly starting with the financial statements. We'll go to the more management tools later on that. Statement of equity. That's going to be how much change in the equity occurs in the company. Like if you've sold some more stock or some preferred stock, it's going to show a lot of that. Now, on simple companies, you may have one, but it's not going to really change, and you probably won't look at it much. But if you ever become a big company and you're always having to raise money, you're going to have a statement of equity that kind of shows that. And last are footnotes. I mean, there's GAAP rules, but people have different times in which they count income. Under GAAP, if it's materially completed, then you can count it. Well, that can be defined differently by different accountants at times, depending on the type of business. So in your footnotes, you're telling you how you're counting it. Now, oftentimes in the finance business that I've been in and still are in with businesses, they give me these financial statements of this property that's worth maybe $20 million. Okay, and they put it on their financial statement. And I said, okay, how much did you buy it for? Oh, we bought it 35 years ago for $350,000. Then why are you saying it's worth $20 million? Well, that's today's value. That's not. That'll put you in jail. Now, if you footnote it and state, we originally bought the property for $350,000, we have an appraisal done on XYZ that says $20 million, we're using that. That's not a GAAP financial statement, generally accepted accounting principles financial statement. But since you footnoted and let them know that's where you're counting it from, you could do that, even though I would highly not recommend that. And the 2 most important ones that you're going to deal with is balance sheet and income statement, also known as a profit and loss statement. If you go to the bank and they give you a financial statement to fill out, it's going to have those two sections. Generally, the front will have the balance sheet, your assets minus liabilities, and the back will have your cash flow. How much do you make, how much taxes, how much your payments for house and credit cards and so forth, and take that down. Those are basically balance sheet and income statements, and those are by far the most important. Also, I'd note on that, if you say you got $20 million in property, say, put an asterisk by there, put a note down there that property's value is $20 million based upon tax appraisal or something. If you only bought it for $350, that's all you can count it for under GAAP rules. So be careful, because they can call that fraud if something goes bad later. A typical balance sheet, the accounts, like the chart of accounts, it's going to have asset accounts, liabilities, and owners' equities or stockholder members' equities, or of stockholders, or if you're members on an LLC. Basically, what you're trying to do on a balance sheet is, if you liquidated the business under GAAP rules, what would the business be worth on a balance sheet? Now, the business may be worth a great deal more. That's called goodwill. And if you have a good brand, that goodwill could be substantial. Matter of fact, if you think about it, Amazon.com, the guy was a billionaire, and it had not made its first dime. It had lost for 5 years straight every month. Now, his assets were pretty low, but the market saw that it was worth a lot more because of the value of the goodwill. The accounts on a balance sheet typically look like this, and you can have much more. This is a very simplified one, but basically, your sample balance sheet, you have your assets listed as cash. There could be receivables. There could be notes payables or receivables. With long term, where you're taking a 4-year contract for somebody, that would be a note receivable. An accounts receivable would be something you would collect in 30 days typically, no more than 90. But typically less than a year, it's account receivable. More than a year, it's a note receivable. Cash is cash. Assets are the total of those. Now, you may have something called other assets, furniture, fixtures, equipment, such like that. Liability, stockholders' equity. Current liability is accounts payable. You generally have accounts payable and accrued liabilities. Now, under GAAP, there's generally two ways of accounting, cash and accrual. GAAP generally requires accrual accounting for businesses. What that means is your accounts payable count when you get them. So if you actually bought copy paper from Office Depot, but you have an account with them where you pay them every 30 days, and that cost you $60 for several cartons of it, well, then you've got an account payable as soon as you take it home, because you've signed on it and you put the $60 deal in here. Now you pay it, you take it off accounts payable. That's accrual method. Under cash, you wouldn't actually book it until you actually paid for it. Like people do in their home checkbook. When they pay a bill, they take the money out. They don't take the money out when the bill comes in. But businesses, you're supposed to take the money out when the bill comes in. If you're a real simple accountant, you can do it just off a checkbook. That's not a problem, and do cash. Just let everybody know in your financial statements it's a cash accounting. Accrued liabilities. These may be liabilities that you accrued, and you have to look at leases. That'll be some. You'll also have notes payable if you have a car that's in the company name that you're paying through the company. Those are types of current accounts. Then you have, once you get all your liabilities, you have your stockholders' equity. If it's the par value of the stock, in this case it's a C corporation, and there's 50,000 shares authorized, there's 5,656,875 shares actually issued, and I've got the others issued and outstanding respectively. There was some preferred I took out. I apologize for this. And the paid-in capital that you may have put money into, and the retained earnings. In this case, they lost $8,682, but they paid in more capital. So the stockholder equity the first year is $13,750, and now it's $16,568. And so that's that's a balance sheet. Income statements. The income statement is where your company lives and dies, especially if you're on cash accounting, because cash in, cash out. Cash is king. You run out of cash and you don't manage it right, you are going to go bankrupt, even if you're making more sales than you could ever believe. So you've got to manage cash properly. You have in the statement of accounts for income, these are operating expenses, operating revenue, non-operating revenue, gains, and non-operating expenses or losses. Now these are things accountants do, but you really want a little more detail in those areas. So I'm going to show you what I like to see as a management. On the income, let's say I have a internet business, but I do some shows like home shows or something, and I sell some things on eBay as my product that let's say it's fencing material. And so you can build fence that are real cute fences or something. You can sell some on eBay. You can sell some at shows and home shows. You can sell some on an internet site, show them how it's done. You can send it to them by the mail. And you want to know each type of income, where the revenue is coming for what type of product. On the cost of goods sold, the next section, you really want to know your website expenses. That's going to be a direct cost. For your website income, you're going to have website expenses. Like if you have a website through us and we're hosting it, it's $29.95. You can take that off there. There may be other things like your merchant accounts and so forth that on a percentage basis. So that would be a cost of goods sold. The direct labor for the shows. I mean, you may have to go to a show 600 miles away, but you're by yourself. Maybe you and your wife. But when you're at a show and you got a couple big booths, you may have to get one or two people there on a contract labor basis. That would be direct labor, and that's again a cost of goods sold. Obviously, the products. Let's say you have two products in this case. The cost of products sold is a direct cost of goods sold because you have to pay for the actual products. And eBay listing fees. So even if you sell it or don't sell it, you generally have to list and have a listing fees, and those are direct costs associated with it. Here's an example of an income statement. It has products 1, 2, and 3 and services for those products. This is the actual dollar figure. This was actually a company pretty much at one time, and I've taken all the names off and the product types off. The material cost, the direct labor, the sales cost. 10% sales commission, but they also get in this case, the sales people get salaries too, a base salary plus commission. But the direct commissions is a direct cost because every time a product's sold, the commission is paid. So that's a direct cost. The direct labor cost, that's the people who are, in this case, were manufacturing the product that were being sold. And the materials that they needed to make those products is a direct cost. So you have all your income here added up. It's 100% of the income, and you know which percentages of that sales comes from each of the different components of that income. And then you take out the expenses. So you have 41% of that income is basically a expense. So you have a 58.96 or basically 59% gross profit margin. Now that's a direct cost. Every time you sell one, that you make 59% of the revenue. But you still have your operating expenses, accounting fees, advertising and marketing. If you go to those shows that you was talking about, you're going to have to pay there. Advertising in periodicals or Google ads or whatever. Bank charges, for collecting the money. Banks charge businesses for deposits. Charitable contributions you want to give to your favorite charity. Contract labor. Again, if you're selling in shows, you may have contract labor where you go. Courier and postage. Credit investigations. If you're doing business with a vendor, you might want to investigate their credit rating. Dues and subscriptions. Corporate payroll. That's a percentage basically of your corporate, your payroll for the corporation. Now down here you see the direct labor cost and payroll taxes. That's payroll for, let's say, the officers, remember that receptionist and secretary and bookkeeper, that's probably their payroll. Entertainment, taking people out, expenses for insurance, legal, licensing, office supplies, etc. Now, the payroll taxes, direct payroll labor I broke out, that's the taxes that are withheld for the people who got paid here in the direct cost and sales commission. And the corporate payroll tax comes from this group. This is actually a direct cost of goods sold, so if you could put it up there also. And that also included their benefits too, like the insurance and stuff, their health insurance. This insurance expense here was other insurance, maybe liability for the different states they go into. Salesman salaries. They have salaries, the sales tax on products in their state. They sold telephone expenses, travel expenses. There could be other things, but this is a pretty standard one. These are total overhead expenses. If they sold zero here, they still have this or close to it every single year, or in this case every 6 months. So their overhead is running $840,000 every 6 months, or about 1.7 million, a little less than 1.7 million a year. So if they sell nothing, their cost is 1.7 a year. Understand that. This number in this group, you want to keep as small as possible, because quite frankly, it's paid whether you do anything or not. So your pre-tax net is this. Subtracting this equals this. It's a 30% margin, which is very healthy. They also had some operating income from interest and other investments, and so they made $906,000. The reason this operating income or expenses is down here, and you can break it down, just didn't have room to do it, is down here is quite frankly, it's not an income from operations. It's an income from banking or from investments. They may have put options or basically bought stock for some of their excess cash or whatever. Those are what that comes from. Now the final considerations. There's three things that people don't realize, and nearly every time they look at financial statements, they do what the accountant says. And they generally do it because what do I need to put, which form do I need to put it on the tax? Well, that's not what a financial statement is for. It is a lagging or historical metrics. I also call them backwards looking metrics, looking behind you. Too often people manage with backward looking metrics, and that's why I call it backward. Think of yourself and you've got your windshield on your car that's been painted, so you can't see out the front, and your side windows in front there. And you have to drive using your rear view mirror, looking at the road as you're going 60 miles an hour down the road. A financial statement tells you what happened in the past. It's like looking behind you, not in front of you. When you're really looking at managing, you do need to know where you've come from, but you need to see where you're going. It's a forward-looking metrics for management. You need to know where that curve is, because if you're looking out the back and a curve happens, you're still going to drive straight off the mountain there. So don't just look at financial statements for accounting or tax needs. Look at it as a manager tool. Know what your costs are. Now, those costs are typically things that have happened. That's a backwards matrix. There are some things you can do to create forward metrics, and we're going to have some on our site that will help you look and see what you need to do to make sure you can make sure that there's cash flow and profit coming through the pipeline. But do financial statements cover your management needs? Remember, I told you need to know what the gross is by percentage and dollar figure of every product or service. You also need to know you're going to have to contribute some of the operating costs to each of those. Now, most of them do it as a percentage of sale, but there's so many ways you can do it. But you've got to cover, every product has to cover some of that operating overhead, because it's there whether we like it or not. So as a management, you need to know if your products break even and past break even, how many numbers do you have to do in each of those products to break even? And we're going to show you how to do break even analysis. That'll be the next video. Do the financial statements also cover legal needs? Remember, I mentioned too earlier that so many people put on their financial statements what property they put in there. Now, if you've bought stock and given an asset at fair market value, you definitely can put that in there at that fair market value. However, if you have an asset in your company that you bought and or been in the company forever, and you bought it for $350,000, it's now worth $20 million. You have to, if you don't footnote it, that's going to be a legal consideration, because later, if anything goes wrong, they're going to say, well, how'd you get this $20 million? Well, that's what I think it's worth. What'd you pay for it? $350,000. So you've really committed fraud. You're telling me something's worth $20 million when it's really worth $350. That's the stuff you got to be careful with. Now, obviously, anything that would be used for collateral will probably get an appraisal of that need of that type So I wouldn't be too concerned about it. But the point is, you got three considerations. First off, it should be your management needs. Then you can look at your accounting and tax needs, and then make sure everything meets your legal. And that's how you really want to do your accounting. We're going to go and look at forward metrics and other metrics and tell you what they are and how to use them, and look at doing break-even analysis and other analysis that will help you managing your business. Good luck with it. God bless.